Hey, I'm coming to you here from my garden in Portland, Oregon. You may hear the garbage truck in the background. It's a Friday morning garbage day. But I want to go ahead and get this video out as quickly as I can. So I'm going to go ahead and do it anyway. So bear with me. And the video that I wanted to do here was, does your S Corporation have C Corporation distribution issues? And this video works well in concert with the other S Corporation videos I've done, so I hope you take a look at those, and that puts some of this in context. In prior videos I've covered S Corporation issues in general that come up when you were previously a C Corp, and I've also covered what happens when a distribution from any S Corporation exceeds a shareholder's stock basis in that company. And what we know about that rule is that if you have an S Corporation that distributes to a shareholder and the shareholder doesn't have any stock basis, that shareholder is likely to have a taxable distribution. That's different than what I'm going to talk about today, which is, when does your S Corporation have a taxable C Corporation dividend? And that's an additional set of rules that apply only in the circumstance that your S Corporation ever was a C Corporation. C corporations, as you probably know, have rules around distributions that lead and refer to what we call the double tax problem. The C corporation files its own income tax return, it pays tax on its income, but then that income goes into the corporation's what we call earnings and profits. And if the company takes that earnings and profits and distributes it to shareholders, we call that a dividend. The dividend is then taxable on those shareholders' personal tax returns. That is the double tax on corporate income. That double tax on corporate income, we may think, or we may hope, goes away when we make an S election, but it doesn't. It doesn't for the income that was accumulated when you were a C corporation. So if you just save up and don't distribute any income as a C corporation and then elect S, that pool, that earnings and profits, is still there. And if you're deemed to take a distribution from that pool, you're going to end up with a taxable C corporation dividend. So that means that we have to do some kind of tracking. It puts the entrepreneur, it puts the company in a position to have to make a determination when they make distributions after making an S election of where those distributions come from. Do they come from the earnings when it was previously a C corporation, or do they come from the earnings when it became an S corporation? Now, fortunately, the silver lining in all this is that the rules on that are taxpayer friendly. And what I mean by that, they're shareholder friendly, because the default rule is that we assume that a distribution from an S corporation comes first from the earnings made while it was an S corporation, and only if those earnings are exhausted would you then look at the earnings from when you were a C corporation. So it's not in a first in, first out order that you might expect. It is actually S corporation earnings get distributed first, then C corporation earnings. At least that's the default rule. The way we do this tracking, we use some technical terms which I'll call buckets. That's very technical, right? But I think it's helpful to think of them as buckets. And that is, as your S corporation is earning income, taxable income, that income that is taxable to the shareholder in a flow-through basis, that income goes into a bucket that we call the accumulated adjustments account. Now let me pause and set context, because context is everything in accounting and tax. I've always said that in teaching accounting students over the years. People often get different kinds of rules confused because they don't know where they're at in the discussion. They don't know what the context is. These buckets that I'm talking about, this accumulated adjustments account bucket for S corporation earnings, this is only a bucket for the purpose of, the context of this is for determining, is a distribution coming from C Corp earnings or from S Corp earnings? Is that distribution subject to the C Corporation? Is it a C Corporation taxable dividend? That's the question, that's the context, that's when we use these buckets. These buckets are actually technically not used for other purposes. And what's confusing about that is that when I say that S Corporation income goes into the accumulated adjustments account bucket, you may have heard me on other videos point out that S Corporation income can fill your stockholder basis bucket. Both are true. That income does fill the stockholder basis bucket, but that's a different conversation, that's a different context. So we have one event, an S Corporation earning income that actually can do that has two different effects. It can fill the accumulated adjustments account bucket, which is used for determining whether you have a C Corp dividend or not, and it also fills the shareholder basis bucket, which is used later for determining whether you have a distribution in excess of basis and other purposes that stock basis may be helpful for. So keep that in mind, that there's different contexts, different buckets for different purposes here. The buckets here that I'm talking about are for C Corp dividend or not. So we've got an accumulated distribution, an accumulated adjustments account, which really means the earnings of that S corporation, the taxable earnings of that S corporation are going into that bucket. Then you've got a second bucket, which is the accumulated earnings and profits bucket. That's the bucket that you already had when you were a C corporation. You saved up those earnings, you didn't distribute them, those funds are still sitting in that bucket. And then finally you have a third bucket, which is what the IRS calls the other adjustments account bucket. And that bucket is where any S corporation tax exempt income, any income that's tax exempt that was earned by the S corporation since you made the S election, goes into this other adjustments bucket. So an example of that, common example used would be the company has investments in municipal bonds that happen to be exempt from federal income tax, and so the interest earnings on those would go into the other adjustments account. This concept then, when you think about the three buckets, this concept of breaking your income or breaking your retained income into three buckets, the accumulated adjustments account, the prior C Corp earnings, which goes in the accumulated earnings and profits account, and then the other adjustments account. These three buckets, again, are only relevant to the question of if your S corporation was previously a C corporation, which bucket does the distribution come from? And finally, the answer to that is it comes from the accumulated adjustments account first until you've exhausted that to zero. Then it comes from the accumulated earnings and profits account, becomes a taxable dividend until you take that to zero. And then it comes finally from any tax exempt income you've earned from the other adjustments account, takes that to zero. That's the ordering of it. This is a very technical conversation. I'm going to do another video for you that walks through an example applying these buckets. Maybe that'll be helpful, but I didn't want to put them in both videos because they'd be too long. So let you break it up a little bit. That's it. I'll see you on the next video. Take care.